Welcome to Synthetic Alpha AI, where artificial intelligence meets institutional trading. Let's decode the market.
Disclaimer: educational purposes only, not financial advice. Trading Forex, CFDs, and synthetic indices involves high risk. Past performance does not guarantee future results.
Every candle on your chart is trying to tell you something. Almost nobody is listening. Somewhere, right now, a trader is looking at a completely blank chart. No indicators, no signals, no colorful lines, and somehow they know exactly what the market is about to do. That is not magic. It is not intuition. It is a skill called price action trading. By the end of this video, you will understand exactly how it works, why it has survived for over a century of market history, and the one mistake almost every beginner makes when they try to learn it. That last part is where most traders quietly fail. Stick around, because we are going to fix that.
Let us start simple. Price action trading is the practice of making trading decisions based purely on the movement of price itself. Not indicators, not news alerts, not someone else's opinion. Just price. But here is the problem. Most people hear that definition and think it means just look at the candles and guess. That is not it. Not even close. Price action is closer to reading a language. Every candlestick is a sentence. Every trend is a paragraph. Every chart is telling a story about a battle between buyers who want the price to rise and sellers who want it to fall. When you learn to read that story, you stop reacting to the market and you start anticipating it. Before anyone assumes this video is anti-indicator, it is not. Indicators have their place. Many professional traders use them alongside price action. But here is what most beginners do not realize. Every indicator, moving averages, RSI, MACD, all of them, is built using price data that already happened. They are not predicting the future. They are summarizing the past and displaying it with a delay. Price action traders skip the delay. They go straight to the source. That does not make it easier. In many ways, it makes it harder because there is no green or red signal telling you what to do. You have to learn to see it yourself.
Let us go through them. Pillar 1, candlestick behavior. Each candle shows 4 pieces of information: the open, the high, the low, and the close. But what matters more is the relationship between candles. A long candle after a period of small, quiet candles often shows a shift in momentum. A small candle with long wicks after a strong trend can show hesitation. It is not about memorizing patterns like a checklist. It is about understanding what is happening between buyers and sellers in that exact moment.
Pillar 2, support and resistance. Here is where most beginners go wrong. They are taught that support and resistance are exact lines, like invisible walls the price bounces off perfectly every time. That is not how it works. Support and resistance are zones, not exact prices. They represent areas where enough traders, historically, have made decisions that shifted momentum. Price often reacts near these zones, not because of magic, but because of memory. Traders remember these levels, and their decisions cluster around them.
Pillar 3, market structure. This is the big one. Market structure refers to the pattern of higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. When that structure breaks, when a downtrend suddenly stops making lower lows, that is often the market's way of whispering that something is changing. Price action traders are listening for that whisper. Here is something almost nobody talks about. The biggest mistake in learning price action is not misreading a candle. It is expecting certainty. New traders often assume that once they learn price action, the market will become predictable. It will not. Price action does not remove uncertainty. It reduces it by giving you context. It shows you probabilities, not promises. Historically, certain patterns have appeared before certain outcomes more often than random chance would suggest. That is different from a guarantee. Markets can and do behave unexpectedly, regardless of how clean the setup looks. Anyone who tells you otherwise is selling something. Price action is not new. Traders were reading raw price movement on paper tape over 100 years ago. This was long before computers and long before indicators even existed. And it is still taught today, in some form, by professional trading desks around the world. Why? Because price is the one thing every market has in common. Every strategy, every indicator, and every news event eventually shows up in price. Price action trading is not about predicting the future perfectly. It is about understanding the present clearly enough to make better decisions.
So, what is price action trading, really? It is the practice of reading the market's own language instead of relying entirely on delayed summaries of it. It is built on candlestick behavior, support and resistance zones, and market structure. And the traders who master it are not chasing certainty, they are chasing clarity. That distinction is everything. Which part of price action surprised you the most? The support and resistance zones, or the idea that indicators are always delayed? Let me know in the comments. Remember, trading Forex, CFDs, and synthetic indices involves high risk, and past performance does not guarantee future results. Trade responsibly.
Until next time, stay patient, stay disciplined, and trade with Synthetic Alpha AI.